Imagine you run a business. Revenue is growing. Customers are happy. The product is working. So one day, you walk into a bank and say, "Can I borrow money to expand?" And the banker says, "Maybe." You assume the banker is impressed by your growth, your sales, your momentum. The banker isn't looking at any of that. The banker is asking three completely different questions. What happens if your biggest client disappears tomorrow? What happens if your costs spike and your margins collapse? What happens if revenue drops 20% and you still owe us $15,000 a month? Banks don't get paid for being optimistic. Banks get paid for being careful. You see growth, they see growth. You see possibility, they see probability. So today we're going inside the room most business owners never enter, the credit committee room. The place where businesses get funded or quietly turned away. By the end of this video, you'll understand exactly how banks think. What a bank really wants. Most business owners believe the bank's first question is, how much money does the business make? That is not the first question. The first question is always, can we get our money back? Everything else comes after that. Think of it like lending a car to a friend. Before you hand over the keys, you're not asking whether they need the car. You're asking, will they bring it back? Will they take care of it? What happens if they have an accident? Banks think exactly the same way, just with hundreds of thousands of dollars at stake. So credit officers evaluate 5 core questions. Can the business pay its bills right now? Can the business survive a bad quarter? Does the business already owe too much? Is the ownership and financial structure clean and organized? What happens if something goes wrong? Those 5 questions shape almost every lending decision. Let's look at the king of all banking numbers. DSCR. There is one number that sits above all others in commercial lending. DSCR, debt service coverage ratio. In layman terms, it means, can this business afford this loan? Here's the simplest way to understand it. Imagine a household earns $1,250 a month. Their mortgage payment is $1,000. After paying it, they still have $250 left. That cushion is the difference between stability and crisis. That cushion is DSCR. In business, banks calculate it like this. DSCR equals usable cash flow divided by annual debt payments. DSCR, what it means to the bank, 1.25 and above indicates strong. Breathing room, bank smiles and approves. 1.00 means tight. No margin for error. Bank gets cautious. 0.95 implies failing. You are losing money before the loan payment. Likely declined. The magic number is 1.25. Think of it this way. For every $1 the business owes the bank, it earns $1.25. That extra 25 cents is the safety cushion. Without it, one slow month, one late payment from a client, one unexpected expense, and the loan goes sideways. Banks don't lend for sunny days. They lend for rainy days. A business that only survives when everything goes right is not a safe bet. DSCR is the gatekeeper, not revenue, not social media, not growth projections. Let's dive into the 6 financial vital signs. A doctor doesn't diagnose a patient by checking one thing. They check heart rate, blood pressure, temperature, and breathing together. Banks do the same. They use 6 financial ratios to build a complete picture of a business's health. The first financial vital signs, current ratio. Can the business pay what's due right now? Compares assets available within the next 12 months against debts due in the same window. If this number falls below 1, the business owes more than it has on hand. That's a red flag. Second financial vital signs is debt to equity. Who actually owns this business? Measures how much of the business is funded by the owner versus lenders. High debt relative to equity means one bad month could tip the whole structure. Banks want owners with real skin in the game. Third financial vital signs is gross profit margin. How much is left after the cost of doing business? After paying for goods, services, or production, how much revenue remains? A thin margin means there's almost no room to absorb a price increase, a staffing cost, or a slow season. The fourth financial vital signs is operating cash flow. What actually landed in the bank account? Profit is what an accountant records. Cash is what actually moves. You cannot make a loan payment with a number on a spreadsheet. Banks want to see real cash, not accounting adjustments. The fifth financial vital signs is asset turnover. How hard are your assets actually working? If two businesses own the same equipment but one generates 4 times the revenue, the more efficient business is the safer borrower. This ratio measures productivity, not just size. The sixth financial vital signs is DSCR. The final answer, everything above feeds into this. DSCR is the number that closes the case. Strong DSCR doesn't guarantee approval, but a weak DSCR will almost always guarantee a decline. Do you know about the secret adjustments made by the bank? Here's the secret most business owners don't know. When your financial statements land on the credit officer's desk, they don't accept them at face value. They adjust them. Think of it like cleaning a smudged window. The bank wants to see what's actually there, not what looks polished from a distance. Depending on the bank, there are 4 common adjustments credit officers make. 1. Depreciation. Added back if equipment loses value on paper but no money actually left the business. That loss is added back. It was never a real cash expense. 2. Personal expenses removed if the business paid for the owner's car lease, vacation, or personal phone. Those are stripped out. The bank is evaluating the business, not the owner's lifestyle. 3. Overvalued inventory, written down old, slow-moving, or obsolete stock sitting in a warehouse, is often worth far less than it appears on the balance sheet. The bank values it at what it would actually sell for. 4. Uncollected receivables removed if a client hasn't paid in 90 days. The bank treats that money as gone. An invoice is not cash until it's collected. The result of these adjustments is what banks call the adjusted or normalized cash flow, the real number they build their decision on. Let's be the credit committee. Company X. Let's walk through a real underwriting scenario. A business we'll call Company X has applied for a loan. Here's what they've submitted. Company X submitted financials: annual revenue $5,200,000, total debt outstanding $1,200,000, owner compensation $210,000, adjusted forward usable cash flow after bank adjustments $440,000, annual debt service payments $350,000. Now the committee runs the DSCR calculation. $440,000 sum of $350,000 equals 1.26 result. Technically approved. DSCR clears the 1.25 threshold. But the committee isn't done. They keep reading. 2 more findings surface in the file. First, concentration risk. One customer generates 45% of total revenue. If that client leaves, Company X loses nearly half its income overnight. The DSCR would collapse well below 1.0. Second, payroll liquidity gap. Payroll requires 21 days of cash reserves. Company X only holds 14 days. In a slow month, they can't make payroll, let alone a loan payment. Notice what happened. The business wasn't declined because it wasn't profitable. It was flagged because it was fragile. And fragility is what banks price. The result? Conditional approval, with higher covenants, weekly reporting requirements, and a personal guarantee. Let's look at the bank covenants. The rules that come with the money. Once a bank approves a loan, they attach conditions called covenants. Think of them as the guardrails on a mountain road. They aren't there to punish you. They're there to stop everyone from driving off a cliff. Common covenants include: maintain DSCR above 1.25 at all times. Submit financial statements every month or quarter. Do not take on additional debt without bank approval. Maintain a minimum cash reserve balance. Notify the bank immediately. If a major customer relationship changes, broken covenants are an early warning system. Banks know that broken promises usually come before broken loans. What happens when things go wrong? The stress test before signing off on any loan? The credit committee runs a stress test. They deliberately make the numbers worse to see if the business can survive. A typical stress test asks, what if revenue drops by 15-20%? A major customer account closes. Why do interest rates increase by 2%? Operating costs rise by 10%. If the business still generates a DSCR above 1.0 under those conditions, the bank has confidence. If DSCR collapses below 1.0 under moderate stress, the bank considers the business fragile. Regardless of how strong today's numbers look, banks don't lend for the best case scenario. They lend for the likely case. How do banks make final decision approve? Conditional approve or decline? Every loan application eventually lands in one of three categories. Here's what determines each outcome. Approved if there is strong DSCR, clean structure, low risk, easy decisions. Conditional approval occurs when there is a close but fixable, may require personal guarantee, higher rate, or monthly reporting. Decline decisions indicates weak cash flow, structural problems, too much uncertainty. Risk can't be justified. The most common outcome for a well-prepared application is not a straight approval or a flat decline. It's a conditional approval. That means the business qualified, but the bank needs protection. Higher pricing, stronger reporting, a personal guarantee, or reduced loan size. Knowing this in advance lets you negotiate from strength, not surprise. Hi fans, let's dive into the important lesson. The businesses that consistently get funded are not always the fastest growing. They're not always the most innovative. They're not always the most exciting. They are simply the most prepared. They understand the rules before entering the room. They know their own numbers. They've identified their own risks, and they tell their story before the underwriter has to guess it. Because every loan application tells a story. The question is, are you writing it, or is the bank writing it for you? The credit committee room is not your enemy. It's simply a room full of professionals trying to answer one question. If we lend this money, what are the chances we get it back? Once you understand that question, you stop begging for capital. You start engineering approval. Remember, prepare the file. Control the narrative. Know your numbers.